basically about the fact that some shareholders want to get rid of their shares. They don't want their shares anymore. So then they go to the company. They don't want to go through the process of selling it on the JSE and whatever. They go to the company, they ask the company, does the company want to buy it back? A lot of times it would be, for instance, a shareholder who died and his kids inherits
the shares.
Yeah, so then they want to buy it back. Now there's lots of implications on that, because in school accounting, it's not like that in real life, but in school accounting we retire the shares. In other words, we're not allowed to issue them again. But in real life we do issue them again. But in school syllabus we do not issue them again, which makes the issued shares less, which means people can now become majority shareholders because the total shares in issue is less. Okay, so it's got implications. So a lot of times it would be directors who are also shareholders who want to become majority shareholders who would buy back those things. So you must look out for case studies where there's something fishy, where they would say something like, he buys it way under the market price, and if he buys it, he's going to become a majority shareholder. Yeah, so you must look out for that. The reasons aren't that important. It's more, they always, this is the note that you will always get. You will either get the note or you'll get a question or an adjustment where you have to do the note for yourself as a calculation. If you don't get it in question 1 with the balance sheet, you're going to get it in question 2 with the cash flow. Okay, there is not even two ways about it. So this is basically the T account. So the T account looks like this. You remember in grade 8 and 9 and 10 and 11, we had capital, né? And capital always had bank on the credit side. Now with companies, exactly the same. It's just we don't call it capital. We call it ordinary share capital, because this capital was contributed by a lot of people and we call them the shareholders. So if the shares increases, if the share decreases. So if the share increases is when we issue shares, which is just a different word for selling shares. And it's important also to remember that the shares that are issued, your issued shares, we also call them your outstanding shares, because they are no longer inside the company, they're outside. Okay, so now the shares becomes more issued, and then we have the buyback on the debit side. So we'll have a balance this side. Whenever we issue shares, it would go to the credit side. Whenever we buy back shares, it would go to the debit side. Okay, because now it makes the shares less. But now, the big thing here is, with the buyback of shares, you always have to work on the average price. So let's say I take, the balance is 100 and bank, we issued 200, which gives me 300 rands worth of shares, and that was 150 shares. That means the average price of the shares was what? 2 rand. Okay. Now let's say I buy back the shares. Now you have to split. I don't know why I do this so big. Let's make it smaller. Now I have to split it. So the buyback price. So once again, in school accounting, we only do that we buy back at average or more than average. We don't do below average, because then we have to get a new T account and stuff, so we don't. They took it out of the syllabus. So now we are buying back. Now let's say we buy back this share for 2 rand. We buy back what? There's what? 150 shares. Let's say we buy back 50 shares at 2 rand 50. Now immediately you can see this is more than the average price. So in the ordinary share capital, you can only show the average price. The 50 cents, the above average, you're going to show in your retained income. Okay, which is what? 25 rand. Is that right? Okay. So that's the basic principle that they're going to test over and over and over again. So if I look at my ordinary share capital note, you will see they divide it into authorized and issued. Now already authorized is what they are registered at. Let me just quickly go through the concept of retained income again. When we make a net profit, because we are a company, we have to pay tax. Now after that, we have profit available to share. And that profit, we are going to decide how much are we going to give to the shareholders in the form of dividends, and how much are we going to keep. And the part that we keep is the retained income. So the word tells you, retained is keeping back a part of the net profit. And you will see that we're going to later on do calculations on ratios with this, where they ask you what is the dividend payout policy, where you will say, oh, okay, this year we paid out 60% of the profit as dividends, and we kept 40% as retained income. Now let's say next year my dividends goes to 95% and the retained income goes to 5%. Then you know, oh, something happened where they want to keep the shareholders happy because maybe they want to pull out their investment, so you want to keep them happy. Or maybe they saw that their retained income is getting too big. They have too much cash that's just lying there, and they want to do this to make the share. It's always to make the shareholders happy. If it's the other way around, let's say the dividends go down to 45% and the retained income goes up to 55%, then you know they are planning something. So it would either be that they want to expand next year. It could be that the political situation is uncertain. It could be like in COVID. So in COVID, they would have to decide, are they rather going to pay out more dividends because they know everybody's pulling hard, or are they going to keep more so that they can at least have funds to pay their workers? So it's different things for different companies. Okay, so that is what retained income is. But let's go back to the ordinary share capital. So the first thing you always do when you draw the note, okay, we're going to do the T account, but the T account we only do up until the presentation that we need to do, because that presentation always asks T accounts. And then we forget about the T account and we work with the note, because the note is the one that will be in the paper 99.7% chance. So what you always do is you draw a column for the units. So you'll see this is how many shares, and you draw a column for the rand value. Then you go right down your format, you write down the shares, the start of the year, the shares, the end of the year. And then you know you're going to have shares issued and bought back. But it can be issue bought back, or it can be bought back issue. So now in this format they show a bracket, meaning a minus, meaning a buyback. So then you say repurchase. And please guys, you abbreviate, because in grade 12 you do not finish your papers. You abbreviate. The marker must just be like, oh yeah, repurchase. Okay. And then what you do is for yourself, you say at average. Because that rand value that you're going to calculate, you're going to get separate marks from this one here. This is either one, and it can even be 2 ticks. Okay. Now let's go look at an example. So then the next one is going to be issued shares. Okay? At. And the at would be the new share price. If I look at the information here, and this is homework exercises that you're going to get. So if I look at this, the first thing I see, can you see they didn't give me in this case? Now remember, it's different every time. So if I look here, there I see ordinary share capital. Can you see it's not at the top? Okay, there's ordinary share capital, and there's a question mark. Now remember, if there were an amount there, it's very important to see the date, ne? And then if you look at the information, it's important because if it's the date and the information doesn't state that all these transactions were showed or recorded, then you assume that this is the closing balance. But you will also have to go and read what they are saying. In this case, it doesn't matter because they didn't give you that answer. So you can't do anything anyway.
So we treat it how we treat.
So we're going to most probably reverse. In grade 12, you reverse in everything. So what I mean by that is they're going to give you enough information here to work it back to the opening. Or they will give you other information. Remember also, and this is the important thing, if we have the opening balance and then the repurchase, the opening, divided the shares in the opening, will give you the average price because nothing happened. So the average price is still the same. Meaning in this exercise, if I can get this average, I know this times this will give me that. If the repurchase is here at the bottom, then I know that the final divided will give me the average. Okay, so you always just need to keep that into account. So now let's see. On the 1st of September, there were 1.8 million shares in issue. They already printed it. On 1st July, the company repurchased 120, which is also printed in this case, at 7.20 each. Now remember, that 7.20 is the buyback price, the repurchase price. This is the total. I still need to get average and above average. Okay, because the above average I'm going to use in the retained income note. But I want the average. So, what is the average? Now they say, which is 20% above the average share price. Meaning, the share price, the share price is 100, then above the share price is 20, so it gives me the total price that I paid is 120. Can you see? You're going to do the UK. So how do I do the UK? I just say R7.20. I know the 7.20 is 120%. What do I want? I want the average price. There. And that gives me what? 6 rand. So now I know the average price is 6 rand. So 120 times 6 gives me 720. Okay, and now I know that 6 is also valid here. So 1.8 times 6 gives me 10,800 million. Remember, in companies, you're always going to work with millions, so get into the habit of working in columns. So you always work in your threes, okay? Which, by the way, is also an easy way to study, ne? If you do everything, you break up your facts in 3 facts, 3 facts, 3 facts. Okay, let's go on. 20%. So here it's also important what they're saying. They say these shares do not qualify for final dividends, which makes more than sense because I already bought it back. It's not included here in the final. Sometimes they will say it still will get because maybe you bought it back right at the end of the financial year. Then you remember to take the final, add back. Okay. So 20% of unissued shares. Now what is unissued? Let's quickly go look. They tell me I've authorized 3 million. I have issued 1.8. Okay? So that gives me 1.2 million. You do not add the 20,000 or the 120,000 you bought back. They are now retired. They're living at the beach. Okay. So now that, 20% of that, we're going to issue again. Okay? And that gives me what? 240,000. So 240,000, they say at 6 Rand 60. And now I get an answer here, and now I just work downstairs. But it could have just as easily been that they didn't tell you the 6 Rand 60. Then you can get the total here, right? Usually what they would do is then they would give this total here. And then you have to work it back to what's issued. And that's buyback of shares.